Foreign exchange trading is not only the largest market in the world, with a daily turnover in excess of $3 trillion, it's also the fastest growing traded market amongst private traders and speculators. We'll be looking briefly at the history of FX, how it's used in the world of global commerce and tourism, but most importantly, we want to show you how foreign exchange trading works, the terminology behind foreign exchange trading, and even more importantly, how you go about placing your trades. In September 1992, I was due to start my university education in England. And I'd saved my money in Danish kroners, and I had a good idea of how much I would receive in pound sterling. But being young and somewhat naive, I had little idea what was going on in the international money markets. But almost to the hour, as I walked to the bank to instruct them to convert my life savings from Danish kroners into pound sterling, drama was unfolding in the international markets, with the Bank of England being locked in battle with legendary speculator George Soros. As they say, the rest is history, but as the pound sterling fell from grace over those hours in September 1992, I made 20% more on my forex conversion from Danish kroners to sterling than I would have done if I had changed my money and my savings only a week earlier. So it's absolutely true when you hear traders state that in the forex market, timing is everything. But before we can cover the areas of entries and exits in the FX market, we need to discover and cover the essentials of foreign exchange trading. The global foreign exchange market is the largest market in the world, with daily volumes in excess of $3 trillion. This turnover is the result of numerous trades made between currency pairs. Currency trading involves the exchange of the value of money in one country against the value of money in another country. For example, should I decide to buy euros, then I can do so by paying in pound sterling. When you trade, you'll always trade a combination of two currencies, referred to as a cross-currency or a currency pair. You will be long one currency, the one you bought, and you will be short another currency which you sold. There are a number of reasons why people engage in currency trading. Whilst on an individual basis, many transactions are undertaken as a means of acquiring foreign currencies, for example for tourism purposes. Other transactions are investment orientated, but the principles behind these transactions are the same. When you go on holiday, we need to pay for our goods and services, so we need to exchange our own money for the local currency. Similarly, companies who deal with international business partners, they operate using the same principle, but of course on a much larger scale. Ultimately, trades that are undertaken in a foreign country needs to be carried out using the local currency. But by and large, the largest group of participants in the currency markets are speculators. Currency trading produces the opportunity to realize a profit. Rising and falling rates of exchange present opportunities for speculators to trade on the market direction of different currency pairs. This means an investor is speculating on the prospect of one of the currencies fluctuating in value against the other currency. The terms trade currency and price currency are used to refer to each currency within a cross. Using euro-dollar as an example, the euro is the trade or base currency, and the US dollar is the price or variable currency. The trade currency is often the one with the highest value. Here's an example of a chart depicting the exchange rate between GBP and USD. GBP is the base currency and the USD is the variable currency. As the USD or US dollar strengthens, the exchange rate will fall. As it weakens, the exchange rate will rise. And this applies to all levels of currency trading. For example, if you're going on a holiday and the US dollar is weak, then you will be able to buy more US dollars for your pound sterling. We should note that foreign exchange is not traded on a physical exchange as it is with equities or commodities. It is conducted OTC, or over the counter. As such, currencies are categorized into three bands. There's the major bands, there's the minor currencies, and then there's the exotic currencies. The following currencies are the most widely traded, and they are referred to as the major currencies. And in that group, you'll find the US dollar, you'll find the Japanese yen, the euro, British pound, the Canadian dollar, the Australian dollar, and the Swiss franc. Most major currency pairs are priced to 4 decimal places. Hence, the incremental movement is that of the last decimal place. This figure is referred to either as 1 basis point or, as it's known in the jargon, as a pip. When, for example, you hear the expression, the price moved 10 pips today, you will understand that the 4th decimal place has shown a movement of 10 in a given direction. The spreads are the difference between the buying and the selling price of a currency pair or rate of exchange, and these are often quoted as bid or offer prices. Forex trading with us enables traders to employ trading on margin. Trading on margin allows investors to buy and sell assets of greater value than the capital in their accounts. So, for example, if your leverage is 100 to 1, it means that if you have $1,000 at your disposal on your trading account, you can control $100,000 worth of assets. You now know the basics of foreign exchange trading. You should now understand the terminology and the mechanics of Forex. And this concludes our introduction to Forex trading.